Good evening, everyone. My name is Don Brown from SCORE Bucks County. Welcome. Welcome to our webinar this evening called Mortgage Options for Single Multiple Rental Properties. We have with us Mr. Dave Provost from Univest Bank, who will be making the presentation. And with you on the line from SCORE Bucks County is myself, Don Brown, and Dave Foster from SCORE Bucks County. And we also want to thank DIG, who is the co-sponsor of this webinar this evening. We're going to wait a couple minutes for people to, other people to join the webinar. We have about 26 people so far. We've had more than 100 people request to join tonight. And then we'll begin. I have all of your microphones unmuted at the moment just to avoid any feedback. You have on your dashboard the ability to raise your hand to indicate if you want to say something, and I'm going to repeat this as when more people log in. And you also have the ability to type in a question, and on your dashboard you either have a box that says chat or questions. I'm not sure what it says, but either one. You can type a question to Dave and to Dave Provost, and I will forward that question to him, and he'll be able to answer them at the end of his presentation. So thanks all for joining. It's 7:02 by my clock, and we'll wait just a couple minutes for others to join us. In the meantime, practice to see if you can click the button on your screen that raises your hand, and I'll see that on my screen to just make sure that it's coming up. Okay. Okay. I see many of you have raised your hand. I'm gonna unclick, or I'm gonna click your hand off. Guys. By the way, this evening we are recording this webinar, and the recording of it will be made available to SCORE and through SCORE and through DIG, and I assume also through Univest. So if you want to see a copy of the recording in a few days or maybe a week or so, we'll have it posted, and we'll send out a notice to let everybody know. Rich Brenner, I'm going to unmute your microphone. You just raised your hand. Did you have, let me know if you have a question. Your microphone is unmuted.
No, everything's fine, Don.
And Todd, do you have a question, or is that just a test? Todd Hirschberger? Okay, I'll unmute. I'll take your hand down, Todd. Okay, folks, it's 7:04. We have about 27 people on the line. I expect we'll have more in the next few minutes. So I'm going to suggest that we begin. So again, let me introduce Mr. Dave Provost from Univest Bank, the Business Banking Relationship Manager. And Dave is going to take us through mortgage options for single and multiple rental properties. Dave asks that we hold the questions until the end, but you can ask questions at any time by typing it into your chat box or your questions box, whatever it says on your control panel there. I will see them, and I will forward to Dave Provost. So Dave, you've got the floor.
Thank you, Don. Thank you, everyone who has signed up and logged in tonight for this presentation. In this webinar, I'm going to discuss mortgage options for buy and hold real estate investors, and we'll start by laying a groundwork of, we'll see on the next slide here. We'll start by laying a groundwork of basic information that will give you some context as we discuss those factors that are affecting the what's, whys, and how's of mortgages and how to apply, and including a discussion on residential and commercial properties and mortgages, and we'll cover players in financing and how they look at real estate investors and the things that affect your loan application and what you can do to help in the process. So, starting with the types of mortgages that are out there, there are residential mortgages. Most people are really only familiar with consumer lending, like new car loans or a home mortgage. Those types of lending are highly regulated, and they're much more competitive because of the quantity of them. Residential mortgages deal in volume and regulations. That's basically what you look at there. As a buy and hold investor, you can get a 30-year amortization and a consumer fixed rate loan, just as if you were buying your own house. And typically you can do that up to about 4 properties. On occasion, and it's becoming rarer, you can go up to 10. And we'll talk about the 5 to 10 Fannie Mae later in the presentation. Commercial is given to corporations, limited partnerships. It can be required by the type of building you're buying or the zoning that's involved, or it can be commercial because you're buying it through that limited partnership or the LLC. Lastly, there's the blanket mortgage, which is funding multiple properties with a single loan. So, as I was saying, with the residential 30-year amortization, fixed rate, typically 1 to 4 units. And the reason for that is because some banks, most banks, sell their mortgages off to third parties. Fannie Mae, Freddie Mac, those are the biggest ones, and they're going to dictate the market. Commercial, when you get to a commercial loan, it's a very different place. So you're looking at a standard in the business is 20-year amortization and a 5 to 7 year fixed rate term. You're going to pay a higher rate. It's a commercial rate than what you're getting the residential market, and typically a commercial mortgage might come along with prepayment penalties. So if you take out a 5-year term and you try to pay it off in 3, you may be hit with a penalty. So what is it? What is residential? What is commercial? To lay some groundwork on that, residential is going to be single-family homes, multifamily dwellings of 4 or fewer units. Fannie and Freddie consider residential to be anything single up to a multi-family dwelling of 4. That's their definition, so that sort of becomes the standard in the market. Commercial is everything else. You got land or industrial property, income-producing property, non-income producing, retail space, office building, mixed use. The other thing that can dictate whether it's commercial or not is who's buying it. Meaning that even though Fannie would say that it's a single-family residence, so it should be residential, it should be a residential mortgage. If it's an LLC that's buying it, it then becomes a commercial property, and it requires a commercial mortgage. You won't be able to buy a property through an LLC and get a residential mortgage. So I hear a lot of questions and opinions and misunderstandings regarding LLCs as it regards to real estate investing, so I thought I'd talk about that a little bit. Again, I'm not a lawyer or an accountant, so the only recommendation that I can make is you want to consult either or both if you're considering an LLC. However, for purposes of this webinar, I thought it was useful to go over some details with regards to how it affects financing and the bearing it has on our discussion tonight. So, to LLC or not LLC, keeping it on the personal side, there are some advantages to buying property as an individual, or buy direct, if you will. You get access to that residential mortgage financing that we talked about with its better 30-year term and lower fixed rate of financing. The disadvantages, you're open to liability and lawsuits. Your mortgage applications and the number of mortgages that you hold will impact your personal credit. And if many of you maybe have experienced that if you own a couple of properties in your name. The other thing about it is ownership transfer is a bit more difficult and expensive. For example, if you have a will in place and you want to transfer owners to your kids, the ownership to your kids, that could be more complicated because you bought it this way. Also, to transfer it, say you want to sell it to somebody, there's a due on sale clause. Maybe you had a partner in there and you want to move it over to a partner 100%. So if you, husband and wife, bought the house, the wife's going to take it over completely. That's going to trigger what they call the due on sale clause in the mortgage, and so the bank's going to demand payment. The other disadvantage is limitations to the size of the portfolio that you can have. Again, Fannie and Freddie, Fannie's limit is 4. Up to 10 in special situations, which we'll deal with later. So if you form an LLC, what are your advantages? Well, your assets and personal is protected because there's a corporate veil there. Ownership transfer is easier. If you want to, you just sell shares in the LLC, and that's not going to trigger a due on sale clause because it's still the LLC that owns it. Just the owners of the LLC have changed. And it's geared towards someone who plans or does have a larger and more diverse portfolio. What are the disadvantages? Higher costs. You've got commercial mortgages, there's shorter terms, balloons, higher rates. You also have setup costs for the LLC. And some people set up an LLC for every property they buy. Some have an LLC and put multiple properties into it. I'm not here to say yes or no to either one of those or venture an opinion, but there are higher costs. Some of the other advantages: pass-through taxation, your personal property protection, slip and fall limits fall to the LLC. It's whatever you become comfortable with. If you want to have one LLC or multiples for each property you have. But the key to whether you go LLC or keep it personal is really, I think, how big do you plan to grow? How many properties you're going to have? The more properties you're going to have, the more likely you should think about an LLC. But again, consult an accountant, consult your lawyer before you make a decision. A lot of people, I ever wonder if people wonder why loan applications go the way they do, or why certain things get asked for and other things not asked for, and it varies from institution to institution. Banking and financing, I think, is one of the most regulated industries, especially in the area where you're lending money. This isn't a complete list of agencies and regulators. I don't intend to go into the details of all the laws and regulations involved here, which I'm sure everybody's very happy about. But the regulations are what controls what happens when you file that application. And there's a lot of things that banks and lenders have to go through and do and comply with that limit what products you see, how things get approved, how the whole process goes. The regulations for the most part break down into consumer and commercial. And the impact on you is depending on whether you're buying it direct or you're going to buy it through an LLC. There are more consumer regulations than there are commercial, but believe me, they're both there and complicated. So this is some partial list of the types of lenders in the real estate arena. You may know some of these. Hard money lenders, they borrow money and then they turn around and lend it to you. So you've got a double markup to deal with there. It's fast. The paperwork and requirements are quite quick and easier, but you're going to pay for that convenience. Brokers, basically what a broker does is he takes your app and he chops it around to his circle of lenders until somebody, and the small community banks or the smaller regional banks, really depends on their appetites. They all have different requirements. A lot of people aren't aware that the regulators or the regulations dictate the total amount of lending any lender can do in the banking world based on their assets. They can only go so far, and they all have committees that sit down and decide what businesses and what type of loans they want to do and what concentration that should be. And again, if the concentration in, say, real estate investing, let's say you've got a really aggressive bank that wants to go after real estate lending, if it goes over 25%, the regulators say we need a whole lot more reports and you need to do this and you need to do that. That's not the real limitation on real estate lending, by the way, but just trying to give you an example of how that impacts the loan process. If a bank during the year hits the limit of the concentration they've decided for that particular type of business, then your loan becomes an exception and it's got another hurdle to cross. So again, why things get approved or not approved sometimes seems mysterious, but there's always a reason. What's your interest rate? That's a question I hear all the time, and I've noticed that most borrowers I talk to focus mostly or solely on that interest rate. I know when I had my own business, that was my first question when I was looking for financing. Now you might think it's funny, but for the banks, this is not their focus of concern really. Banks and other lenders really care mostly about their rate of return. And without getting into all that finance 101 and all of that math, banks can make money in more ways than the interest rate that they charge. It's similar if you know bond and stocks and bonds and bond pricing. The price of the bond goes up when the interest rate goes down, and when the interest rate goes up, the price goes down. So that's that kind of relationship. A bank can charge a higher upfront interest rate and use fees to offset that interest rate and still make that same return that they're looking for over the life of a 5-year loan. So they may be looking for a certain rate of return. They can charge you that rate up front and get it over 5 years, or they can charge you a lower interest rate, pile on some fees, and over that 5-year span they make the same amount of money due to the present value of money. What would I give you for if I wanted $1,000 in 5 years? What would I take today? That's kind of what they look at. So we talked a little bit about Fannie Mae previously. The reason you hear about the 1 to 4 properties as a limit is because of around the time of the financial crisis, they limited the number of properties. They rolled back the rule in 2009 that prevented real estate investors from owning more than 4 properties, and they put it back up to 10. Now, you might not have heard that, and it's because most banks don't offer that 5 to 10, and one of the reasons why is because Freddie stayed at 4. So if you're a bank, you know, you want to have the most customers to your loan portfolio that you're trying to sell as you can. So if Fannie was at 10 and Freddie was at 4, they kept it at 4 because banks are conservative. Now, last year Freddie moved to 6, but most loan originators are either not aware of it or they're not moving off of the 4. But in any case, these are the requirements that Fannie has. If you can find a bank that would, you know, that does participate in the 5 to 10 unit Fannie Mae program, you can look at this criteria list and see it's quite a bit more stringent than your typical mortgage. And one of the things I point out on this screen is the second from the bottom. There must be 6 months of principal, interest, taxes, and insurance reserves on each of the financed properties. And you may have heard that kind of reserve number before. You might find banks are not really that concerned about that part of it. And the reason for that is cash can walk. So you're going to find, and we'll get into this a little later on, that a bank is going to look more at the debt service coverage ratio, which tracks cash flow on a monthly basis, as opposed to, hey, I got this reserve of cash sitting over there that I have to cover my expenses, to cover my repairs, to cover my management reserves. You could buy a property in 2 weeks and that money may be the down payment, so it's gone. That's why banks are not that enamored of that particular requirement. One thing I've been asked frequently is, do banks look at the total dollar amount that we have financed, or is it the total number of properties that I own? And when I get asked that question, I typically say yes. And you know, the reason is, while every lender has their own secret sauce, if you will, on how they evaluate investors in the deals that they're presenting, there are some basic guidelines. So a bank will look at and weigh the total exposure they see against your cash flow, that debt service to cash flow ratio. They're going to look at the global debt service for all your properties, and they're going to look at that specific deal that you're trying to fund right now. And it's going to be a combination of that. They're going to look at collateral quality. Not only do they want to have proof that you can pay them on a monthly basis, they want to know that if something were to happen, you have collateral, and it's usually the property that you're financing. Collateral quality comes into it. We'll talk about that in a minute. The other things that banks weigh is is it personal, is it a commercial loan? Does the bank hold the loans in-house, or do they sell them? Again, most banks will sell their mortgages. And this is one that if you've been doing this a while, investing in real estate, either as a flipper or as a buy and hold, they're going to look at the documented experience of an investor. That's not only tax returns, but it's also a resume. So you might want to think about putting together a business resume or a business description of your experience and your results as a real estate investor, and make that a part of all of your loan applications, because it speaks to who you are. When you talk to banks, they talk about the 5 C's of credit. Character is one of them, and character is experience. So just a bit of food for thought there. So Blanket mortgages. What's a blanket mortgage? It's a mortgage that covers two or more properties, multiple properties in one load. Traditionally, they were given to building developers who would subdivide, build, and then sell off the pieces. So Toll Brothers, they buy a farm out and they build 30 homes. They're using a blanket mortgage to do that, and the real estate, again, is held in collateral on the mortgage. It's the same with a blanket. You're going to hold that property. The difference is that in a typical mortgage situation, it has a due on sale clause, which we talked about earlier. So any change in ownership is going to trigger that if you've got a regular standard mortgage. So if you had 4 properties held in a blanket mortgage and you wanted to sell one of them off, that in a traditional mortgage would trip that due on sale clause. That's the trigger. And it would push the mortgage into default and cause the bank to settle with you. So a blanket mortgage has a release clause. And what that allows you to do is you put multiple properties in there. If you had 3 or 4 in there, you sold one, the bank would calculate the percentage that that property represented, figure out what the balance is that's left, and the mortgage would continue at a reduced size because we've taken a piece out. Usually or typically, if you find a bank that does blanket mortgages, they're going to only do 3, 4, 5 maybe properties. Typically, anything bigger than that, unwinding that blanket becomes more difficult. Builders and developers can do it because it's more clean-cut and easier to understand and more uniform. In the real estate investment world, where you're buying up disparate properties, unwinding them gets more complicated, more expensive. So typically it's 4 to 5 properties or less. So how do I get a blanket? What are the qualifications? You need to have a credit score of 720 or higher. You're going to need to be a little better a credit risk. The loan to value is similar or the same as a commercial mortgage, 65 to 70%. And they're going to use the appraised value or the purchase price, whichever is lower, if there was a recent purchase involved in that package of properties. There's always going to be an appraisal required on all of the properties. The collateral quality will play into it. Documented cash flow, and we'll talk about both of those in a second here. And they're going to want to know the purpose of the blanket loan. Cash out, what are you going to use the cash for? What are you trying to reduce the expenses because this rate on the new mortgage is less than the old one, improve cash flow, that kind of thing. So I mentioned collateral quality a couple times now, and it basically boils down to how the lender balances risk in their portfolios, in their loans. So step 1 in evaluating a loan request is determining is the borrower generating enough free cash to make that loan payment. But to protect the investment in case the worst happens, and again, think of it this way, if it was your money on the line and I was borrowing it from you, you'd want to protect your investment. Banks want to protect their stockholders' money. They want to protect the money of the bank. To protect that investment, in case that worst happens and the borrower can't pay back the loan, it goes into default, they want collateral pledged so that the lender has a chance of getting their money back. The quality of that collateral is then the consideration. So better collateral is a high value properties, say a single-family residence over 100,000, 200,000, 300,000, a multifamily, triplex, duplex, a 4-unit apartment building, or a mixed-use space where you've got office or retail on the first floor and a couple of apartments above. Those are more readily marketable. The quality is determined basically by how fast and easy it can be sold and for how much. So the less desirable collateral are sub $100,000 properties. Single family homes, $50,000, $30,000, $60,000. They are expensive and more difficult to recover on, and so therefore less desirable to a bank. So the other part of it was cash flow, and I'm going to take a short detour here to capitalization rate. When I've been talking to investors and I talk about cash flow, I frequently hear them say, "Oh, I know what you want. You want a cap rate." Actually, that's not really what the bank is going to look at when they're evaluating the loan. The cap rate is typically used by investors to evaluate whether or not they should purchase a property. It's based on the sale price, and it helps you determine, hey, am I going to make money if I buy this or not? It's going to take your gross potential rental cash flow and take away your costs like taxes and property insurance, reserves for replacement of the items in the house like heaters and hot water heaters, management reserves, repair and maintenance allowances, and a vacancy allowance to come up with your net operating income. And the cap rate becomes your net operating income divided by the sale price on the property. And that, again, is a ratio that's used by investors to figure out if that property makes sense for them to buy. For the bank lending you money, that's not so much what they're looking at. What they want to look at is, in commercial and investor real estate, the bank wants to know the debt service coverage ratio. So what is that? It's looking the same at the beginning as a cap rate, gross potential rental cash flow, less those expenses we talked about. Part of the secret sauce that banks have when they evaluate these, though, is how much they set aside. Not everybody uses the same formula for management reserves, replacement reserves, repair and maintenance, and vacancy allowances. Probably most folks on this phone call or this webinar have different allowances when they're looking at that cap rate to figure out whether they should buy the property or not. But understand that what that allowance and those reserves are dictates the end ratio that comes out. So being conservative is not a bad thing when you kind of evaluate whether to buy the place or whether to lend money to someone who owns the place and is looking for a mortgage. But at the end of the day, we get a net operating income here as well. But that debt service coverage ratio is now that net operating income divided by your debt. So if it's a free and clear property and we're negotiating for cash out, we're looking for a mortgage, then there's only one debt payment that we're concerned about. If, however, you have a $250,000 property that already has a $100,000 lien on it that you put into it for rehabbing that place when you bought it, and now you're looking for another debt or another loan on that, you're going to combine those two to come up with that debt payment. The number we're looking for is, at a minimum, typically 1.25. In other words, what the bank is saying or what the lender is saying is, we want to know that you can at least cover your debt service payment with the net operating income and then some, a quarter of that. Again, if it's higher, that's better. So 1.5 is better than 1.25. going back to that for a second too, when you're looking at a blanket mortgage, or, well, we'll deal with the blanket first. Blanket, you could have 5 properties in a blanket, and one is only at 1.1, while another one is at 1.45, and so on. As long as the aggregate of that is well over that 1.25, that's not going to knock you out of the box because you have one property that's not yet covering its ratio. The ratio is not quite there yet. Keep in mind too that for any commercial mortgage or mortgage for that you're looking for, whether it's personal, direct purchase, or through an LLC, this debt service coverage ratio, they're going to look at that for your property and the deal that you're looking at right now, whether it's a single or a blanket. They're also going to look at the rest of your portfolio. So they want to see and make sure that LLC 123 and LLC ABC is sound before they lend money to LLC XYZ over here. Tax efficiency, it's best title I could come up with for this slide. It's no secret people and businesses do what they can to reduce and avoid paying their taxes. Entrepreneurs and business owners oftentimes tell their accountant to find whatever deductions they can to reduce the impact of taxes. Hey, I had a good year this year. Let's find some places to lower that tax burden. Believe it or not, people who own businesses put a few personal things through their business. IRS even acknowledges that. Sometimes it's more than that. It will reduce your tax burden for this year. But the issue comes in when you're looking to finance properties or to get loans and financing. That issue of reducing your tax burden by increasing your expenses is going to hurt you on loan applications. And it's also going to hurt you if you decided to or came to a point where you wanted to sell that business. In evaluating your loan application, whether it's for a single property or a blanket mortgage for multiple properties, the bank wants to deal with as much fact and provable information as it can. So it's going to look for documented cash flow as opposed to that Excel spreadsheet and rent roll that you've carefully put together and manage your business with. Why? Because what you told Uncle Sam is, to their eyes, fact. The rent roll is honest. That's what my expenses really are. That's really what my rent is, and so on. So when you're applying for a mortgage and applying for a loan, we want a documented cash flow and a rent roll. So you're going to look at the income from your past tax returns. If you are minimizing your taxable income all the time, you're hurting your chances, you're reducing your cash flow, your documented cash flow, and therefore hurting your chance or chances of getting that loan. Also, because most lenders want to see a documented cash flow and they're going to look at the tax return, then the word seasoning or stabilization comes up to mind. In other words, you need to have that property purchased, rehabbed, and rented for a period of time so that it shows up on your tax returns. So it's 12 to 18 months to substantiate and back up the rent roll that you're presenting with your loan application. That's what seasoning is all about. That's what some banks call stabilization of the property. If you're a buy and hold investor, you want to show that, yes, I have this property, I've rehabbed it, and I've rented it. Here's my experience with it. You want to, they're going to look at your principal interest and the documented expenses that you see, that they see on your past tax returns as well as the income. So you really, if you're smart, you want to talk to your accountant about what deductions he's taking or she's taking and what the ramifications are of how they're doing it. Because there's more than one way to do it. Again, I'm not an accountant, and I don't pretend to give tax advice, but a simple example is taking an expense on your tax return to reduce your tax burden that really could have been classified as a depreciated expense. When you look at cash flow, if it's an expense, it reduces your cash flow. Depreciation gets added back into your cash flow, and therefore it doesn't hurt it. So if you put it on the tax return and in the accounting system as depreciated expense as opposed to a regular expense, you haven't hurt yourself. That's just one example. It's not the only way that can be done. Again, talk to your accountant about this stuff, because if you just leaving it up to them, they may, you may be pushing too hard in the wrong places, and it may come back and affect your finance options. If you're Donald Trump and you don't have to worry about obtaining loans, self-finance it, then go for it. Get all the tax deductions you can. But someone once told me when I had my business, it's good to make money and it's also good to pay taxes. So just to touch on this for a second, this came up in conversations about putting this presentation together. About the SBA and SBA loans. Small Business Administration offers loan programs, and those programs are specifically for businesses and for specific purposes. So what those loans are they're not direct loans to a business. What they are loan guarantees or lender guarantees. So if you are an SBA lender or an SBA bank lender, it means that the SBA would guarantee a certain percentage of that loan should you default to that bank. So therefore the bank is taking a little less risk and is more willing to give a loan to a new business. They're not direct loans. There's two different programs. There's 7A is general small business loans for working capital, for equipment, for sometimes for properties, for basically anything that a small business might want to borrow money for. It's a variable rate loan, and again, there are two types of SBA lenders. There's preferred lenders and there's just an SBA lender. The difference being a preferred lender does the underwriting in-house. If you're just an SBA lender, then the SBA has a hand in approving that loan. Has to do with how quickly that loan can be approved and turned around, and having local control over the loan application process. The 504 program is a program specifically for major fixed assets or large commercial properties and things of that nature. It's a three-party loan, meaning the borrower is putting in money, the bank, the conventional bank, would put in 50% of the loan, and a certified development company, which is a nonprofit entity that this 504 program allowed to be created, covers the other 40%. And again, it's for up to $15 million, and it's for bigger assets. In a default situation, the private lender that's providing 50% gets paid first on a default. But and then you know, for commercial real estate, again, 7A and 504 loan programs. The thing about 7As and 504s, whether it's for a business or for commercial real estate. If it's for commercial real estate, it's got to be 51% or more owner occupied. You can't use this. SBA does not approve or do residential property purchases. It's just, it has certain prohibitions on loans made to individuals and businesses engaged in speculation or investment in real estate. That's right off of the SBA website. They don't want to invest in real estate unless the business is occupying the real estate. So, summing up where we've been, you know your situation. Are you a residential direct purchaser? Are you commercial? Are you buying a commercial property? One piece of advice is build and protect your personal credit rating and build it up as high as you can get it, because that's the first thing anyone's going to look at, and it's going to dictate how successful you are in obtaining your loans. You want to track and manage not only your cash flow, your debt service coverage ratio on the deal that you're working on, whether it's this particular one purchase or it's a blanket mortgage. You also want to manage your global cash flow throughout all of the properties that you own. Use realistic reserves. I've seen on the web people setting up things like 5%, 6% for vacancy and for maintenance. That may help you when you're buying the property. If you really want to go out and get it financed, if you want to get a loan on it, you should allow higher rates. I think most lenders would be more north of 8% to 10 or more on vacancy reserves, management reserves, and the like. When you're looking for a loan, balance your rates, the interest rates they're offering you against the fees they're charging you, and take a look at that. If you're concerned with what you're going to pay over that 5-year period on that loan, you know, fees could have as much impact as the interest rate. Manage your profitability and taxes when you are submitting your tax returns. Talk to your accountant, and you know, build an investor's resume. Questions?
If anybody has any questions, either raise your hand on your dashboard and I will unmute your microphone, or post a question in your question box. Any questions, please? Oh, come on, there's a lot of people on the line. There must be some questions here. Okay, Gregory. I have unmuted your microphone, Gregory. Go ahead. Gregory. Gregory, are you with us? Okay. Gregory's not answering. So any other questions? Gregory, are you there? Okay. Well, while we're waiting for Gregory, you had one of the previous listeners sent you a question. If you look at your chat box, I sent it to you. Do you see it there?
I don't. Hang on.
It says, when you say disadvantage is limitation of 4 properties in portfolio, is that for individual properties or for loans? In other words, can you have 4 blanket loans that each cover 4 properties?
No. I'm trying to just understand the question better. So the limitation of 4 properties is on the personal side. So in my own name, indirect, I can own up to 4 properties typically and get a mortgage on them. Beyond that, unless you can find a lender willing to get into that 5 to 10 Fannie Mae program, you'll have difficulty getting another mortgage. So that's the limitation in terms of number of properties. A blanket loan, on the other hand, is for rolling multiple properties into one loan. So you wouldn't need 4 blanket loans to cover 4 properties. You'd have one blanket loan that would cover 4 properties.
Okay, does this answer the question of the person that asked? If not, raise your hand, we'll try again. Okay, I just said a question. What are the target rates and how do they vary by property type?
Well, again, cap rates are something that, you know, has to do with whether I should buy the property or not. I'm not an expert in target cap rates for different types of properties. As far as a borrowing situation goes, buying a residential or a commercial property, I'm looking for again, debt service coverage ratio, and that ratio, whether it's commercial, mixed use, residential, you want to have that cash flow ratio at 1.25 or higher.
Okay, thank you. Deborah Nye, I just your microphone. Go ahead. Deborah, are you with us? Deborah? Okay.
Here, can you hear me?
Yes. Okay, we can hear you now. Go ahead.
Can you hear me?
Go ahead,
Good.
please.
Okay. All of this info is really helpful regarding the 10 properties and the Fannie Mae and FHA, et cetera, et cetera. But here's the thing, how do you get around it? Because, for example, I've got 10 properties, and I'm sure people listening are in a similar situation. How can you get to 20? I mean, it just seems to me I have to do commercial loans every single time, but am I going to cap out? Am I going to tap out as far as quantity on those? Do you know what I mean? I don't know if it's clear what I mean.
I understand.
Okay.
So yeah, look, the residential mortgage market is there to help people buy their home, their primary residence, and though it's used by real estate investors because there are you know, built-in availability for people to purchase properties up to 4 to 10, 5 to 10 if you're using that Fannie Mae program. If you're at that many properties, basically you have a business. That's a commercial situation. So yeah, you're kind of limited to commercial mortgages at that point. And that's where.
And is there a limit on those?
Well, yeah, there is a limit on those. Any commercial deal has a limit as to how good a credit rating you are, what's your score, what's your cash flow, how good is your debt service coverage ratio, how much debt do you have overall within your whole portfolio versus the income that you're generating, how much experience do you have in doing this kind of thing. So it's a risk portfolio, and while
so there's no limit as long as I meet all of the criteria.
Right. Nobody's saying that you can only have 20 properties.
Okay.
Theoretically, there's no limit. But it's the law of large numbers, or whatever, I don't know how else to put it. But it's your overall risk presentation and opportunity that you have when you apply for that mortgage.
Okay, gotcha.
And again, the commercial mortgage market is different. You're talking 5-year balloons versus a 30-year mortgage.
I have many of them with your bank.
And the key part of that, though, is if you stay with get a commercial loan, 5-year balloon, you stay with the company that you started with, the rule, as long as everything else is in place, should be relatively easy and less costly than getting another one
Right.
From another bank.
Okay, thanks so much.
Comment to Deborah in response, and Dave, please expand on this. You said before, Dave said before, Deborah, I don't know if you joined or not, a collection of properties, and some of them do, some of them don't do very that debt coverage ratio, that aggregate your blanket mortgage is over 1.25. And you're okay. But David, why don't you explain it more?
I know what debt service coverage ratio is. I know, and I know how to calculate it. I'm just not sure if it goes on each individual property or the whole portfolio.
Yes, to answer your question. When you go, I'm going to bring this again. When you go and apply, let's say you had a new property, let's say you had a property that you wanted to get a mortgage on. You said you own 10 and you're looking for a mortgage on 1. They're going to look at that debt service ratio for the one deal that you're submitting, but they're also going to evaluate your global debt service coverage ratio for all your properties. And the reason for that is the nature of real estate investing. It's in the financing world, it's looked at as a very risky thing, as opposed to other businesses. Rightly or wrongly, lenders look at it as a high risk type of loan.
Dave, there?
Yeah, we just lost. It says I got a message here. I just lost the webcam.
Okay. For you, so please continue.
See if I can get it back.
There we go. Okay.
Yep, there you are.
Okay. So you know, rightly or wrongly, and you know, as the SBA, they prohibit real estate investing. It's just the nature of the business. So the reason they look at your global cash ratio is once a situation starts to go south, even though you might have multiple LLCs, or maybe you own all the properties direct, it doesn't matter, but it can bleed from one property to the next. After all, you're the owner, you're the one who has the property, and it's been known that you borrow from Peter to pay Paul, and things can fall apart. So they want to make sure that if I'm lending you money on property 11, that you've been a good steward of property 1, 2, 3, 4 through 10, and that you're maintaining your debt service coverage ratio at a reasonable rate for all your properties, and then they'll consider the new one. Does that make sense?
Yes.
Thank you, Deborah.
Thank you.
The chat questions that I sent you, Dave. One says, can you give a specific example of the debt coverage ratio? I think you just did that, actually.
Yeah, I mean, basically, I can go through this again quickly. You're looking at your total cash flow coming out of that piece of property, your gross. Take away your taxes that you pay and your property insurance that you have to buy, and then the rest of this is forecasting. So replacement reserves. What is that? What do you need to reserve for replacing refrigerators, dishwashers, garbage disposals, hot water heaters, heating and air conditioning, those kinds of systems within the house. So you have a reserve for that. Sometimes people separate that out. Sometimes they roll it into the repairs and maintenance reserves or allowance. But basically, you need to set aside something to cover anticipated future repairs on that property. You also need a management reserve, which covers the cost of running your business, of having that property out there. And then you also have to allow that at some point in time you're going to have a vacancy. Again, as I said before, different lending institutions have different rates, and you probably have a different rate than someone else when it comes to calculating what those reserves are when you buy a property. Some people may figure 6% for each one of these things. Some may go as high as 10% vacancy, 10% management reserves, 10% maintenance. You know, it's part of the expense that goes into calculating the net operating income, and then that net operating income that's left. Let's say all of that stuff above comes to 35%, plus your taxes, say 40%, and you're making $1,000 a month. That means you have 600 net operating income divided by your debt payment, whatever that might be, depending on what the amount you're trying to borrow. What's the monthly on that will give you your debt service coverage ratio.
Dave. Gregory, Todd, are you still with us? Your hand raised. Gregory?
I am.
Okay, go ahead, Greg. Ask your question.
Apologies for earlier. I didn't realize we were doing audio chats. I was typing into the chat box. Thank you, Vic. I had just a very quick question on the housekeeping item. Do you have any sample investor resume to share?
I'm sorry, you broke up there. Investor what?
The investor resume, would you have any samples that you could direct us to? Format,
well,
content?
I don't. You could Google that, and you'll see some samples out online. I mean, typically, what I'm saying with that is not you're not looking for a job. You're trying to describe your business. So if I'm investing in real estate, I have a real estate investing business. How long have I been doing it? What's my background? Was I a property and maintenance guy for 10 years and then I started buying my own properties? Or was I a general contractor and I started buying houses after the downturn and rehabbing them and flipping them, and then I started to hold them? You want to describe what your experience is and make note of your successes. Say, hey, I bought a house here for this, sold it for that. Bought this house, sold it for that. This is what happened in 2014. I had this house or this property, this triplex for 3 years, and over that 3 years I've had this vacancy rate and this net operating income. In other words, you're sort of reporting on the state of your business, telling the underwriter that I've been around the track once or twice, I know what I'm doing, and when I do it, I have a good result. So in evaluating my loan for this new property, please take into consideration that I have the capability, the wherewithal, and the experience to do it. That's all you're trying to convey in that. And it doesn't have to be long. You don't want it to be multiple pages. You just want it to, you know, like a regular resume. Make a page. Highlight the good stuff.
Thank you. May I ask a quick follow-up?
Yeah, go ahead.
Sure.
By the way, Greg, before you say, I just want to say to everyone that's still on the line, it's a little past 8 o'clock, and if it's okay with David Provost, we'll stay online to answer as many questions as we have. So is that okay with you, David?
I'll stay as long as people have questions, yes.
Okay, great. So Greg, go ahead. Ask your question.
Thank you. I appreciate it. One of the challenges I have in looking at properties and is understanding whether they're fairly priced. And I'm not a realtor yet. I don't have my license, and I have limited access to, quite frankly, I can't be bugging my realtor every day when I see something and I want to see if the seller's selling at a fair price. but I wondered if I can use the rent rolls to back into what would be a fair price. Somewhere in there maybe is the cap rate or the old 1% rule or something, but I always seem to come up awfully light, or else the market's quite strong for the sellers. Any advice there? Using the rent rolls as a way of sort of coming up with a fair price.
Well, yeah, you're on the right track there. Again, going back to that cap rate, which is typically used for something along those lines, you're going to take that rent roll, which is going to give you that gross potential rental cash flow that's coming out of there. It should, if you're talking to the realtor, he's probably giving you the taxes and property insurance. The rest of this stuff, though, is, as I said, everybody has their own formula for what the reserve should be. What should I allow for vacancy? What should I allow for reserves? Those things can have a big effect on the net operating income, and therefore what that cap rate would be on that particular property. If somebody was asking me personally, I'd want to be conservative in anything I was bidding on, and I would try to nail down these costs as best I can, and use it as a negotiating tool. Okay, you want $200,000 for that, but the cap rate that you're presenting only allows 6% vacancy and 6% for repairs. It's not enough. In my experience, 8% or 9% is more appropriate, and if I do 8 or 9%, then I'm coming up with a lower purchase price for that property. Given the marketplace around where you're at, you want to look at the rental market. What are people in that area getting for rent? What's the rent range there? And what are the selling prices? That's something that the real estate agent should be able to give you, what the properties are selling for. Look, at the end of the day, a property is only worth what somebody's willing to give for it, period. And there may be a time when the demand for that property, because of its location, creates a crazy price on that. And whether you're willing to pull the trigger on that determines whether you're the buyer. I mean, it's the Wild West out there as far as that goes. But I would, if I was an investor in real estate, I would use this cap rate and things of that nature as a negotiating tool to say, hey, I'll give you this for it because that's what it's worth to me, because I know if I buy it and put the money into it if I need to, and or even if you don't need to put money into it, I just know that the expenses of maintaining that building and keeping it rolling and allowing for these things are higher than what you're accounting for, so therefore I'm willing to give you less, or your price is fair and I'll pay it. I don't know if all this helps you, but it's kind of the way I would think about it.
Very much so. Thank you.
Okay, are there any other questions?
I see one here from someone online that says, what's the typical lending rates, and do I think they'll go up or down? I don't know if that person is still online with us, but do I think the rates will go up or down? I think they're eventually going to go up. All loans are going to be keyed off of what the Fed does, and the Fed hasn't changed its, well, last year it raised a quarter, but before that it had been static for a very long time. We're pretty much in a zero-rate environment, so everybody on this phone call and every bank out there is sort of in the Wild West. I don't think the U.S. has ever been in a place where interest rates have been so low for so long. So what's going to happen next is anybody's guess. There are many things that affect the lending rate, and again, residential, the metrics in residential are very different than what they are in commercial, and the things that affect the lending rate they're different. So rates, I don't even know the residential rates because I'm more on the commercial side, but commercial rates could be anywhere from 4.5 to 6, 7. It really depends on even 8. It really depends on the risk and the credit strength of the person applying for the mortgage and the deal that they have in hand. And so they're, not everybody can get the lowest rate. You have a higher risk, you probably will pay a little higher rate. And some institutions have a floor rate beyond which they typically don't go. Although there's no hard, fast rules in any of this stuff. It really deal specific and institution specific.
Dave, there's a question about a mobile home park. Do you see it there?
I don't yet. No, hang on.
I'll ask it for you. Are there any special requirements for financing a mobile home park?
You know, I am not. I'm not sure I could answer that properly. The biggest thing that sticks out to me, and again, you know, if that person sends me an email, I'll get the right answer from the right people in the bank as to what the specifics are on it. But my initial reaction to the question is, going back to what's important when we're making a loan is, one, can the borrower pay the monthly debt payment? So we want to make sure the cash flow is coming in from that. The second part of that is collateral. And in a mobile home park, you don't have bricks and stick, you don't have mortar that you're financing. So I'm not financing a building. Am I financing a mobile home park with pad sites that are then rented out to the people that own the mobile home, that they move onto the site? Am I financing the mobile home that's being put on the site of the mobile home park? Those questions have a bearing as to how the mortgage or how the financing would go and how it would look. And again, specific, if I am financing a mobile home park and I'm going to finance the whole park and the pad sites, and people are bringing in their mobile homes, for example, as one description of this situation. What else does that borrower have? What kind of strength is that borrower presenting? Do they have collateral other than the property there that can be used and to shore up the fact that you're just buying a plot of land with some pad sites on it? I don't know if you answered the question, but yeah, I mean, it's definitely different than buying and financing a home.
One of the question was, unlike a regular house, a mobile home, the mobile homes can drive away. So that
correct.
It's a little troublesome. Okay, Shaw, can you hear me? If you can, please ask your question.
Yes, can you hear me?
Yes, sir.
Mm-hmm.
Okay. So I typed my question, but on the formula you have here for cap rate, is it advisable to use also principal and interest as your expense items when you're calculating net operating income?
No, you wouldn't. In the cap rate, yeah, you could put it in there. It is if you're looking at the cap rate. It is if you're going to be financing part of the purchase of that property and using the cap rate to figure out whether you should or you shouldn't. Yeah, you could do that. But here, when you're talking about a rental property and I'm looking to do a cash out refi of that property, the principal and interest part comes in under the debt payment. So the debt payment is where the principal and interest it comes. So the net operating income wouldn't include that.
Okay, that's good. Thanks.
Thank you. Does that answer your question, Jay?
Yes.
Okay, thank you.
Yes.
Okay, Dave, a couple of other questions. One is debt service or principal and interest. Not, that was asked. Jay answered that or asked that. Next is, can I get a blanket loan line of credit similar to a HELOC on 5 properties, currently free and clear, and how much over prime terms? How much over prime would it cost?
So we're not looking at a mortgage per se. We're trying to get a line of credit on 5 properties. Yeah, I mean, if the deal holds water, the deal holds water. Basically, the purpose of that blanket loan, when I'm talking to this group of folks, you're typically looking to get your money out so that you can do some other purchases. So you've got an investment in a group of properties. You want to get that some of that investment out and use it to purchase some new properties. Again, you're moving your risk from your portfolio, from your money to the banks, which is one reason why you know, real estate investment loans are not typically popular with large banks. You're moving your risk to us, and in this particular case, you're asking about a line of credit. It's the same thing. You're looking to get cash out. I assume you're looking to get cash out because if a deal comes along, you want to be able to spring at it. So whether you need the money right now for a particular purpose and you're going to take a blanket loan out on those, or whether you want to get a line of credit so that you have that ammunition in your belt in case something comes up in the next 1, 2, 5, 6 months, it's really the same thing. You still can get a HELOC type device. It's not called a home equity loan because obviously it's not a home. It's a line of credit, commercial line of credit, and yeah, so you can do that, or you can do a regular 5-year loan and pull the money out and buy the property right off the bat. So either one works. As far as how much over prime and what the terms would be, again, if it's a commercial loan, it's going to be typically 5 to 7 years in duration. It's a balloon. It's going to have 20. Sometimes a bank might do 25 amortization. In other words, they'll amortize that loan over 20 years to come up with a lower monthly payment, but it'll be due in 5 years. That's the typical standard in commercial lending. And if it's a line of credit, obviously a little different than the mortgage, but what the terms would be and what the rate would be really depends on the situation. Again, they run from, I've seen rates out there from 4.5 to 6, 7, 8, depending on the situation. So you'd have to put together your particular deal and your background information, make an application to come up with that specific rate.
That question was from Matthew. Matthew, are you still with us? Do you have any follow-up questions? Matthew, are you still with us? Matthew, I've unmuted your microphone. Matthew?
I sent it in. I don't know if you can hear me.
Oh, I can hear you now. Go ahead. Go ahead and follow up.
Thank you very much. Yeah, you're pretty much exactly right. What I'm looking for is a little more ammunition to buy some nicer properties. And I don't know what they are yet, but when they do happen, you have to move quickly. So I look for something like a HELOC because that's what I use now, a home equity line of credit.
Right.
But you answered my question, so thank you.
Thank you.
Thank you, Matthew. I'm gonna mute your mic now again. If you need to have a follow-up, just raise your hand on your dashboard. Okay, let's see. I think that's all the questions that have come in on the chat box. Does anybody remaining on the line, if you have any questions, either send it in on your chat box or raise your hand and I'll unmute your microphone. Okay, Gregory, what's your follow-up question? Go ahead. Gregory, go ahead. Gregory, you're online. Go ahead. Gregory, go ahead.
Sorry, trying to find the mute button.
Okay.
Thank you. I hope I'm not dominating, but I do have a quick question, maybe to follow up to my earlier question about the value of the property. Owner financing is the the godsend, right? For us getting started, it is anyway. And so, is there a particular value to that, a premium that you'd be willing to pay on the purchase price of the house if the seller is offering seller financing? And what would that be? It's kind of a gut feel thing, I suppose. But any insight?
So could you ask the question again? I want to make sure I understand it. In other words, you're buying a property and the owner's willing to finance part of it?
Right.
And so the question is what in regards to that?
It becomes a negotiation, I suppose, on the price of the house, right? If he's willing to offer B financing, I guess I might otherwise be in a position to ask for a lower price. But if he's going to be so generous as to offer me financing, there's maybe a compromise there. And what are the rules of thumb or instincts or gut feels on what that's worth? It's probably a very individual and specific question.
Yeah, it is. And the other part of that equation is, or the other part of the question is, how are you putting money into it? In other words, are you self-funding the rest that the owner's not financing, or are you coming at that with a bank loan as well as the financing?
So the properties I have in scope at the moment, and there's a whole portfolio this gentleman is hoping to sell. He's looking for 20 to 25% cash. At least that's how I would approach it. I would have cash, but he's asking a very above market price for the property, because I think his strategy is because he's offering above market prices, or asking above market prices, he's financing. So, but then on the other hand, he's making money on the financing as well. So perhaps that should be an angle we should pursue then.
Well, yeah, I mean, if he's offering to finance the rest of it and you put down X and he's going to finance the rest, in other words, he's becoming the bank. And so he's going to charge you more money up front and then become the bank. Well, is that the situation?
It is, yes.
Yeah, so that's a situation where you've got to decide how that looks. The factors that I would consider in a situation like that would be, am I able to get my own mortgage, my own financing, without going to the seller to get it? If I am, is the rate he's charging me significantly less or the same as what I would get if I got conventional financing? If it's significantly less, is it worth the difference between paying the higher price and the lower payment versus conventional and a lower price? It's all the time value of money, how you want to look at it. Pay me now, pay me later. And without knowing the specifics of the situation, it's hard to say. Property is worth what a property is worth at any given time, and sellers put properties up for a certain amount. They don't always get what they want, even if they finance it. It's what somebody's willing to pay them is what it goes for eventually.
Greg, this is Don. Another way of answering your question is what's your plan? Is your plan to keep the property for the 20 years or 30 years, or are you looking to keep it for 5 years and sell it? And I don't expect an answer right now, but that's a factor in evaluating whether you should pay a higher price and a lower interest rate like David was mentioning, or the other way around. So thinking that. Okay, did that answer your question for the moment, Greg?
It did, very much, thank you.
Okay. David, if you has any follow-up questions after this session, how can they reach you?
They can reach me at that email address. Actually, that's the wrong email address. Oh boy. Okay. It's that one right there.
Okay, so it's provostd@univest.net.
Yes.
And that's
or that phone number, 954-8212.
Right. Or if you want to reach out to me at SCORE, just go to the buckscounty.score.org website, and there's a phone number there and some other links. So either way, Dave will be glad to help you, or contact SCORE or contact DIG if you have their contact information. Okay, well, we've gone almost 30 minutes past the witching hour. Are there any final questions, or should we give Dave a chance to take the rest of the evening off? Raise your hand on your dashboard if you have any other questions. Okay, well, speaking for all of us, Dave, thank you so much for your presentation tonight, and this was terrific. You did a great job putting the slide deck together and answering all of these questions. And if anybody has any follow-up questions, they know how to reach you. And I want to thank Dave, and I want to thank SCORE Bucks County, and I want to thank DIG for supporting this event. So with that, I'm going to wish everyone a good evening, and thank you very much. This recording will be posted, as I mentioned earlier, on the SCORE, on the DIG website, and possibly the SCORE website, and possibly the Univest website. And we'll send a note out to everybody and let you know where you can get it. Oh, somebody actually asked about your slide deck, Dave. Will your slides be made available, or just the video?
I guess we could work something out with the slides, yeah.
Okay, all right. We'll send a note out to everybody and let them know. Okay, well, thanks again, everyone, and have a good evening, and we'll call it adjourned for now. Thanks, everybody. Good night.
Thank you.